Everybody, welcome to Global and Local Asset Management. My name is Mauro Fallen. I am the Managing Director of Global and Local Asset Management, GLAM as we like to call it. With me today, I have Carl Eisenhinker, who's our Chief Investment Officer, and the Portfolio Manager of our Global and Local SNN Worldwide Flexible Fund. Carl and I are going to talk around the themes in the fund, which can be broadly explained by the title of this webinar, which is The World is in Chaos. Before we get on to that, let me take you sort of a minute just to tell you about Global and Local Asset Management. Global and Local Asset Management, or GLAM as we like to call it, is an asset management company which has grown out of an advisory company. So as a result of that, we understand what investors' needs may be and what they might be missing from their portfolios. We manage about R1 billion across 4 different funds, but we are different. So pretty much when we looked at opening an asset management company, we decided that we were never simply going to launch funds the type of funds that are better managed by somebody else. So we were never going to look at a value fund. You know, the value guys out there are very good at what they're doing. So we started off with managing funds on an actuarial basis, using a strategy known as the avoiding the human factor. And we have a balanced fund of funds, and our 4th fund is the Global and Local SNN Worldwide Flexible Fund, which we're going to talk around today. Let me introduce you to Carl over here. Carl is our Chief Investment Officer, as well as the Portfolio Manager of the Worldwide Flexible Fund. Carl has a very interesting history. He's actuarially trained and has worked in the investment industry for many, many years. Now, I know that at one stage of his career, Carl decided to run away and join the circus, and he took a step away from the industry and became what is known as an aerialist. And to you and I, that means an acrobat. He's still involved in some format with a company called the Cirque, and he is the CIO here at Global and Local Asset Management. Now, let's get into The World is in Chaos. How does this translate into the themes present in our fund? Carl and I are going to sort of just chat around that. And if you have some questions over what we talk about, please put them in the chat, and we can answer them at the end for you. Now, I've been in this industry for pretty much 30 years, and I can't recall when last I saw socio and political environments with such volatility, and this affecting the markets the way it has very recently. But my experience also tells me that where there's chaos, there's opportunity. And it is how one identifies opportunities and how one benefits from these opportunities that is important to our investors. So, Carl, let's get into that now. Good afternoon, Carl.
Oh, good afternoon.
The Global and Local SNN Worldwide Flexible Fund is a macro-themed fund that looks at global themes and has the flexibility to move freely between SA and global asset classes. That's in our name, Global and Local. The focus, though, is offshore. Are you ready to talk about chaos in the world?
Oh, yes.
Okay, right.
Let's go.
So let's start with the first theme, and the first theme there is energy. Okay, oil and gas has been affected by the climate change activists. And Carl, am I right in understanding that in oil and gas prices, they were always going to be increasing? We foresaw that a while ago.
Yes, this is happening. I mean, a lot of people there's a lot of blame that the oil price increase has been as a result of, the war in Ukraine. And it certainly made the problem a lot worse and brought it forward a lot. But this has been happening for a while. And it essentially comes down to, because of ESG, which is economic, social, and governance development, most institutions and financial institutions, which are pension funds, banks, haven't been allowed to really invest in oil and gas and many of the commodity sectors anymore because they create too much CO2, which it is right. I mean, if we don't get the climate thing right, then the world is in real trouble. I mean, we know we're just in lots of trouble. But essentially what's happened is they try to transition too quickly without taking account of how quickly we'd be able to get out. So we're in the situation now where they've starved capital completely from the from commodity producers. So the oil companies, the gas companies, we're currently using almost 40% more commodities and energy than we were using 15 years ago, whereas investment into the industries at 15-year lows. So the whole problem comes in that there is just not enough supply at the moment. And yes, renewables are coming on, wind and solar, and eventually we'll all have electric cars. But that's taking too long, and we've reduced our supply of basically, of the dirty fuels too quickly. And that's what's really causing the problem. This is all just being, brought a little bit forward by what's happening in China, Russia and Ukraine. But that's not really the cause.
Jump in there quickly, Carl. So when we're talking energy and we're talking oil and gas, and that not only affects transportation, but heating prices. Yeah, and where we are at the moment, we're going into northern hemisphere winter. We're starting to head that way.
Well, I mean, currently, oil and gas inventories are at historic lows, which are normally summer would be the building, would start building those up. And Russia's not helping that. I mean, if we just have a look at the oil price there, you can see how it's getting close to the record it hit, back in 2007. But what's actually happening is it's very weird. It's with all the start here, we've had a very strong dollar. Part of what's happening as a result of the Ukraine war and just high inflation in America being a little bit more aggressive than Europe and Japan in terms of allowing interest rates to go up. So as a result, it's looking quite strong in US dollars. But if you actually look at it in other currencies, you can see in many other currencies around the world, it's actually at all-time high prices. And what's happening is it's still going on. I mean, for example, if you were to take, the Russian, what's happening in Russia now, if we were to lose that Russian oil, which is about 5 million barrels a day, I mean, oil prices would be nearly double to where they are now. Now, Russia hasn't had its production lost because currently it's all being bought by India and China, which are doing it quite complicated because they actually have to use small boats to go into the ports because all of Russia's infrastructure takes it out to the west, to Europe. It's been already full scale, whatever they can pump through pipelines and to the east is already at maximum, so there's no more. So they have to put it into small boats, then go into bigger boats, and then even to bigger boats to get them through to Asia, all transferred at sea, which is really difficult, but they managed to do it. So in fact, Russia's actually getting more for its oil now than it was before the Ukraine war. So
sanctions haven't worked.
Yeah, they've actually made Russia richer rather than poorer, which is why the ruble is so strong, just interestingly enough. But if sanctions are going to work, and Europe's trying a few ones now, and Russia loses that, we start losing some of the Russian crude, then we get in a real problem. Because one thing about the Russian oils is Russian oil supplies, it's all based out of Siberia. Now, Siberia goes through the permafrost. And when you're going through a frozen layer, you have to keep flow. If they stop, they don't have a storage for it. As soon as you stop flow, what happens to the liquid? That freezes. No, well, not all the oil, but some of the freezes, and then they actually break. And the only way they can redo it is to re-drill. Now, when the Soviet Union collapsed, oil out of Russia, production fell dramatically. It only got back to the same level, in December 2021. So almost 30 years later. Okay. So if it goes down, it's not coming back. And then we're almost like structurally. Already we now know that OPEC, which we always said had more supply, doesn't have more supply. We all heard that last week when Macron said he spoke to, MBS, and MBS said, sorry, we can maybe in 6 months add another 1 million barrels. So we're at capacity. There is no more oil that can be done at any time soon.
There's plenty of oil, but we can't get to it.
Not quickly, it don't take time. And the reason why is it takes 5 to 7 years to build an oil rig, an oil plant, that type of thing. But everybody knows oil's dying, so nobody's investing in it because that the policies don't want it. Nobody's got capital, so as a result, we haven't been building them 5 to 7 years ago. We could build them now, but people still don't think the price is going to last. Yes, you might be in a spike there, but to build something that'll only get your money back after 7 years when you know it's going to disappear. So that's almost, you've got a mismatch of time between climate goals and what you actually can produce at the moment.
Okay.
And that's where the problem comes in. Now, natural gas prices, at least oil has one thing in its favor, is that, oil you can move around. It's, liquid at room temperature, you can put it in boats, you can ship it around, and oil, you get slightly different types of heavy, light, and sweet and sour, and all of those type of things, but generally oil is oil. Natural gas, on the other hand, is a gas. So in order to move gas from place to place, you're either going to have a pipeline that you build, or you have to take it, you have to build this hugely expensive and complicated plant to freeze it, to make it cold enough that it goes liquid. Then you've got to put this in these very expensive ships that are very technically, so that you can send them across the ocean. Then you've got to have another plant either side that can, basically warm it up so it goes from liquid back to a gas. All of which is extremely complex because natural gas is by definition very explosive. So not getting that right is a really big problem, as we saw with the explosion that happened there. It doesn't take a lot to have a big problem. So as a result, the fact that US has got natural gas sitting at $5 to $6, Europe there, who's also now dependent on Russia, is sitting somewhere, in the region of like almost $40. Same with Asia, because they can't get the natural gas. And that was even when Russia was pumping what they could. Now you've got Russia threatening, wanting to cut it off because of sanctions, because of the war. So natural gas prices have gone vertical, and they really are the problem. I mean, that's probably you'll see lots of geopolitical action happening this winter when Russia's going to try to force, Germany to break NATO, to get out of, stop supporting NATO or freeze. And literally, we'll see it happen, but Germany at this point doesn't really have that much choice.
Okay, so how does Europe heat themselves in winter?
Well, they've now gone back to coal. Okay. So all the climate goals are out. They've started all the old coal ones again.
I can just imagine the German Green Party having a problem with this. This is going to be fun.
Because the other thing that's interesting here is you can also see the price of the refiners. So those are the guys that turn oil into petrol and diesel. Now, diesel also has gone up way more than even petrol because you need natural gas to convert, because you need to remove the sulfur out of the oil for diesel. So diesel's even gone up. In South Africa alone, we've seen diesel prices go up, 45% in the last year, and petrol's up 27%. And, especially, we will, and if Europe is in any way successful at stopping Russian oil getting to India and China, you can see at least another doubling. That means we're talking over 40 rand a litre for petrol in South Africa.
Wow.
So,
and higher for diesel.
Yeah, even higher for diesel.
Which will affect agriculture prices, which we'll get on to just now.
Well, not just agriculture, all industry, because industry runs on diesel, trucks run on diesel, everything runs on diesel. So that's a really big problem. So and actually, it's the kind of situation where Europe's, they're trying to sanction those boats that are through the insurance company that are getting everything to India and China. In South Africa, I think we're also buying a lot of Russian oil, I've heard. But the point of it is, if they stop that, and they are able to stop it, if they really want to, they just have to shut down insurance or just say, non-aligned boats aren't allowed to go through our waters with oil, and Russian oil can't get out. But the side effect is it ends economic activity for the rest of the world almost.
Sure.
I mean, just imagine how dealing with 40 rand petrol, especially for low income people where transport is such a large part of their cost base.
Okay, so based on what you've seen now, where are the opportunities? Where we go?
Well, we've done quite nicely in investing specifically in oil producing producing companies. We've done really nicely in the refineries, because they've also gone up really well, because you've seen the margin on the refineries gone up from what used to be like $5 to $60. So they've seen almost 10 times increase in margin. I mean, that's the whole thing why Biden's been going after these guys saying, oh no, they're price gouging that. But it's supply and demand. All those no new refineries have been built in the US for 15 years. Our refineries here in South Africa are also old and almost dying. Once again, because it's there, nobody wants to put in the billions of dollars you need or rands, in our case, to actually build something that you think is not going to be around in 10 years' time. Because everyone's going to be driving electrical cars. So it's just the timing of the
cars are powered essentially by coal at the moment, which is
pretty much even in Europe now.
In Europe, yeah. Okay, so refiners spread at record highs. The next slide that you were going to show us is?
Well, now I'm just going to get on to, pretty much one of the best opportunities that we see in the space has to be in nuclear.
Okay.
Because once again, climate goals are important. Now, nuclear has been avoided by everybody except maybe the French and the Chinese. So, I don't think there's been a nuclear power station built in the US Germany's been closing all of those down. Even Japan have just been closing them down because they've just got dependent on natural gas because it's cheap and it's easily available. The thing is, nuclear power is far more efficient at generating energy than any of the other sources. Not only is it more efficient, I mean, it doesn't take up a lot of space. Think about even on renewables, how much space does wind farms take up? Now, if you look at the equivalent here, 3 barrels of oil is equal to a gummy bear size of a uranium fuel pellet.
Okay. So you're talking about uranium fuel pellet the size of a suit, basically.
Yeah.
And those little gummy bears.
Yeah. So that holds as much energy as 6 tankers. 6 tankers of natural gas, a ton of coal, 3 barrels of oil.
Wow. Okay.
So firstly, it's very efficient. Uranium is pretty much everywhere. Now, going back to the green side of things, nuclear is by far the lowest CO2 emitter of any of the energy sources. Now, if you look at the second and third one, which is wind and solar, which everyone's moving for, remember, when you want to build wind and solar, you've got to actually extract all of those minerals out the ground. There's a huge amount of lithium, nickel, rare earth metals that go into building a wind farm and solar farms. So never mind the space they actually just take up, but in terms of the actual resources used to make them versus how much energy they produce over their lifespan, you can see that wind is actually creates a lot more CO2 than nuclear. Solar creates way more, even hydroelectric. In terms of, think about all the resources going into building those dams, into building all of those ones. They just actually cost more. So once you actually get into that, nuclear is actually the greenest fuel. But people have always been saying about, it's the danger of nuclear. What about Fukushima? And really the whole thing happened is, people started shutting it down after the tsunami hit Fukushima and there was that accident there. And when you actually look over the entire time of nuclear for all accidents, because people take very good care and a lot of nuclear plants are really well built to be able to withstand even planes hitting them and that. You can see that, including the accidents, which is Chernobyl, which was the biggest one, nuclear has had the lowest mortality rate out of any other form of energy production. Now, obviously, coal's the most dangerous.
Because it gets mined,
Yeah, because it gets mined and fires and all those other ones there. Accidents in hydro, but nuclear is actually by far the safest. And what's interesting is, then everybody says, the other big thing about nuclear, which has been its big negative, has been it's the whole waste profile. What happens about nuclear waste? But if you look at the entire nuclear waste that's ever been produced, it's a tiny cube, 96 feet per side. Look at that there, you can see compared to a Boeing
96 cubic feet.
Yes, that's it. That's the entire waste.
What, about 30 cubic meters?
Yeah.
Yeah.
So 30 cubic meters. And what that does is, pretty much we've never had a major incidence of waste leakage from any type of waste, because they're able to secure that very safely underground, and there's not a lot of it they can secure it. So from that point of view, nuclear makes a lot of sense to be the green energy of the future. And there has been a lot of negativity on that, but we're literally in a situation where now they're having to burn coal because they let it go too long, and now we've had to go back to the dirtiest fuel with the high CO2, the high mortality, all of those problems.
Okay, so the opportunity at the moment, as you said, is refineries, oil, and coal.
No, uranium.
Uranium. Yeah.
No, actually, we have bought a lot of coal in the fund because we saw this huge increase in coal pricing, and that's actually one of our really good. Especially that's we've mainly offshore, but we've done well out of Tingela in South Africa.
But then
we did see coal as a possibility.
Surely South Africa is such a big producer of coal, should be taking advantage of this. Why can't we?
Well, we are to an extent, but the biggest problem is Transnet. If we could actually get our coal out of the country, South Africa would be printing money. Okay. Unfortunately, we pretty much what we can get out, we're selling for literally almost 10 times what we were selling it a year ago. But you just can't get enough of it out. So we've got lots of coal. What we can get out, we sell a lot, but South Africa is still being highly limited by what we can get.
Transport infrastructure.
Okay. But going back to nuclear, you can see there's a lot of nuclear that's being built out now. Finally, I think it was only the last week or two, you're eventually seeing Germany stop shutting theirs down, everybody else there. I mean, China, you can see China has had no problem with, they fully understand that nuclear is the solution. I mean, they're building more nuclear power stations than everybody else in the world combined.
Wow.
And as everybody else starts realizing it too, it's only likely to increase.
The interesting thing I see there is that France is not building.
Well, France has a lot, but they're going to probably start building a few more now. The big thing is everybody's going to have to come back. Germany, there is no choice. They're either going to have to leave NATO and get Russian natural gas and say goodbye Ukraine and goodbye Poland and goodbye half the other countries, or they're going to say we're going to have to build up nuclear and just suffer through as much as we can at the moment. I mean, we're going to see what happens in winter, but Germany's getting to that choice. literally it's getting to that choice. Now, if you look at what's currently planned, so these aren't assuming that Germany and other countries are going to start changing them. Just look at what we've currently got planned. You can already see there's a huge gap between what is currently produced and what is required. The blue being what's produced, and the runoff from the current mines, and what's being and what's required there in the red and the green.
Wow. Okay.
So you've already got a huge gap. So what happens is there's not enough uranium.
Okay.
And we don't have time to go into the details of how we had a bit more, because a lot of it was coming out of the old nuclear weapons from the USSR, because we had a lot less refining capacity than what they call underfeeding the reactors, which turn mined uranium into uranium-208, which is what you can use in reactors. So that actually kind of produces a bit of uranium. Now they have to overfeed, especially since the West has now lost access to China's Russia's refineries, which were the biggest in the world. So now suddenly there's even less supply, on the market.
Okay, so a good one is uranium.
Yeah.
Okay.
And just quickly, I'll pass it down here. But this is, you can see the uranium had its last bull market. You saw it went up over 2,000%. So really up, and we've actually been in for about a year now.
Yeah.
So we've got quite a large part of this run, but it's still just starting. And this time, I think it should go a lot higher, because this time it's, the world has no choice. When it's got no choice, it has to go there. The fundamentals of uranium are the best that any market has ever seen there. So, we don't try to time it, because with all commodities, they're very volatile. But if you sit in it a long enough time, I really believe that this will be a great investment, both in the actual uranium itself, which we hold some in our fund, and also in the miners. I mean, the miners are the lowest market cap of any of the energy producers. It's tiny. While it's 10% of global energy production, it's only it's a tiny amount of it's a tiny valuation. One stage at 33 billion. I just also wanted to mention that what's interesting is, compared to other forms of energy production, the actual price, the nuclear plant is very expensive to run, so the nuclear cost, the fuel cost, is less than 2 or 3% of the actual cost.
Doesn't matter.
So if it doubles or triples, it doesn't really add a lot to the cost of producing nuclear power.
Okay.
So that's why we see a lot of value in uranium.
All right. Let's move on to the next thing, because I think we're going to run out of time.
Okay.
So we've spoken about the uranium and the cost and all of that. All this translates to higher energy prices. What does this do to global food prices? How does this affect? I mean, we spoke a little bit about it earlier, but there's from our previous discussions, things like fertilizers and agriculture. Talk us through that a bit. Okay,
well, the scary thing is about it, I think we're literally on the cusp of a global famine of, as I said here, historical proportions. I mean, things for the food side are really looking dangerous. And once again, this isn't because of the Russia-Ukraine war. Yes, it's made certain things worse, but a lot of this was happening anyway. I mean, we got into the fertilizer and food trade already last year, before Russia-Ukraine was in the thing. And you can see it here. There's the fertilizer price. It's pretty much tripled over the last year. Now, fertilizer, there's two types of fertilizer. You've got ammonia, potash, and phosphate. Ammonia is basically made from natural gas. So with the increase in natural gas prices, which you've seen up there, that's also, that's pushed up the price of ammonia. Also, that's pushed it up there. Now, since the Ukraine war, thanks to sanctions, Russia, who's the second largest supplier of potash, and Belarus, which is the third largest supplier of potash, so the other type of fertilizer, they've now been taken off the world markets. And then China halted all of their phosphate exports. They did that last year in around about September, because they had avian flu and they needed to secure the supply of their own supply. So what's happened is you've lost, China was about 30% of the phosphate trade. That's going to disappear.
You've got an interesting graph that shows us that. But you keep it.
Oh yeah.
That one, yes.
Okay. Yeah. So as you can see, so essentially, most of the now once you're taking China, Russia, and Belarus out of the fertilizer market, you're pretty much losing roughly 30% of the of your fertilizer. Now, the problem with fertilizer is, yes, you can run your fields, for 1 year without fertilizer. You'll get a slightly lower yield, but the big problem is next year.
Yeah.
So next year, suddenly, because you didn't fertilize the year before, then you have a massively reduced yield. Now, I can't remember offhand the figures, but it's something like a third or whatever of what you could do if you have to then plant the following year, if you planted the previous year without fertilizer and you're doing it the next year. So what's going to happen is next year is where we're going to see the real problem start hitting on the food supply.
So if we just look at, I mean, what you put up on the screen now, Russia, Belarus, and China, that's, I don't know, guess what, 30% of the world's fertilizer out the market.
Well, yeah,
Okay.
20, yeah, just over. Yeah.
And on this side, you've got, in the blue side, you've got Canada, US, and Morocco.
Yeah.
That's about 30% of, and those are the big ones. I mean, the others are, I mean,
We've done nicely
tiny.
because we've invested in some Canadian fertilizer stocks, which have also done really well for us. So and once again, we were into that from last year already. So, so looking at how it's actually affecting food inflation. I mean, here you got it for, you see the light blue one is 2019, 2020, but you can see by 2021, long before we even saw Russia and Ukraine, before any of those issues were happening there, you already started to see a steady food price increasing. From 2022, once Russia, we started using the fertilizer from Russia, we started getting the wheat, using wheat from Ukraine, losing, all the other grains coming out of Russia, the seed oils also out of Ukraine. And then the knock-on effects, you can see it's gone vertical. It's come back a little bit since the oil ban from Indonesia stopped. But once again, I think that's that's a temporary reprieve.
Which countries is this going to affect? And I know you've got a slide on that.
Well, it's everybody. I mean, here it's just breaking it down so you can see in specific ones. Where we've been in there, you can see vegetable oils, which is the big rise up now. But you see, as I said, wheats and cereals, which are the basic foods. Dairy's gone up. Even meat started to go up a lot just because of the rising feed input. Yeah. Remember, food, as we said before, your food input costs are fertilizer, which is the biggest one, but also diesel, which is up, like I said, so much. That's it. You use diesel for tractors. You use other ones like paraffin for drying of the wheat. So you end up, as fuel costs go up, that dramatically increases the actual cost for farmers. So you have a situation where farmers are having to decide, is it worth actually planting? Because at this point, if food prices don't go up, I'll lose money with my crops. So, what you said from the input, from the squeeze of having less on the market because of Russia, from that, the food prices are just, we're getting squeezed and getting squeezed badly. And again, you can just see there's the inflation. And this is where it gets interesting because, remember we had in 2010, back then in 2010,
the Arab Spring.
That was the Arab Spring. Food prices have already gone higher than that now. They're already sitting, well above that. Now, so that's already there. Now, remember, half the Middle East fell apart at that point. So if you have a look at the map of the world,
this is the map. Yeah, period.
Yeah. So this is it. So if you end up looking at where in the world, which countries are food insecure, these are the countries that are going to have problems. I mean, somebody like Saudi Arabia is going to make money with oil, so they'll be able to buy. And they should be able to survive. But all those other countries at the top there, all the way through to Saharan Africa and Sub-Saharan Africa, to pretty much with the exception of like South Africa, Zimbabwe, and Zambia, Africa is in real trouble. We're food secure, but if we're looking at this, I mean, it's going to start with, you'll see it as people can't eat. That's the one thing that gets them out into the streets. That's when you're starting with protests, coups, civil wars, governments falling.
Wow.
And you can see pretty much most of those countries are going to be, you'll see by next year, once that the trend happens. I mean, we already had 900 million people food insecure as a result of the pandemic. Wow. Now we're hitting them with massive loss of
inflation.
Yeah. And the question is what happens if some of the other countries, stop exporting? Like I said, we saw India do it. If they stop exporting, there's just going to be no food available at any price for those poorer countries.
That's right.
So that's I think where the scariest part of the world is. South Africa is once again lucky because we are food secure.
I find it interesting that places like Mexico looks like they and Italy are importers of food. I thought they would have been exporters. I mean, I can't imagine Italy without wheat or pasta. So,
well, luckily they're part of the EU next to France, which is a huge producer.
Yeah.
So even if even with the loss of their trade, they'll probably be able. And they're a rich country; they can afford to buy it. Italians can afford 3 times the price for their pasta. Sudan can't. 3 times the price. Egypt can't. That's the problem.
Yeah. Okay. Where are the opportunities here? What are we looking at? So,
all right. Well, I was just going to show just a little bit more. I mean, here you look at the food price in, say, Turkey and Egypt. This is food inflation.
Okay.
So once again, before we just look at the opportunities, what we have to consider is how is it going to affect places like South Africa? Yes, food prices are going to be up because South Africa, we are food secure, but until we put an export on food, we're going to keep our prices going to keep going up, which is why I expect a food ban to be put in place just to keep the peace. Until that happens, we'll probably end up seeing, like we saw in September last year, more of those riots because of the food and fuel prices, where people just can't afford to eat. They can't afford to even get to work. And I think the government would be happy to, keep it going. And it's a balance, because if they push the food prices too far down, how the farmers pay 3 times or 4 times the price for fertilizer, double the price for diesel, they need to still make profit. So it's a mixed bag here.
Yeah.
At least we can still produce. But it's going to be a problem. It's just starting now, but you'll see. We'll have to look at that a lot next year. And in terms of where we've been, making money, like I said, on the offshore side, we've been buying the producers and buying the fertilizer and the manufacturers. The people that will be, in the places to benefit from this when it starts, as it gets worse.
Okay. But hang on, just go to the next slide quickly.
Okay.
Inflation expectations still transitory. Now, you and I were chatting about this earlier, and you made some quite interesting comments in that inflation is transitory, so it will get better.
Well, this is what I'm saying here is, I'm not saying inflation is transitory. I'm saying the market expects inflation to be transitory.
Okay.
In the US here, which these are US inflation figures, it just hit 8.6, which is the highest it's been for
40 years or something. Yeah.
Since the 80s. But what this graph shows is that it's still expecting the 10-year inflation is still only looked at as 3.3, which means the market is expecting inflation to be transitory. It means it's high now and they expect it to come down. That's what the market's expecting.
But the only way it can come down is if the Fed increases rates at a much more aggressive rate.
Well, exactly. So the Fed, after we had that 8.6 spike, the Fed gave it a 75 basis point increase, which was bigger than expected. Well, not expected because it wasn't expected by then. But, they said, the Fed always used to work on what they call forward guidance, because they tell you, they said, we're doing 50, 50, 50. Then the inflation came out more than expected. And they said, oops, the whole market suddenly was expecting 75, and they had to give the market what they wanted, which shows now that the Fed is doing what the market's demanding rather than what they say. So forward guidance is now out of the window, because that they'll react based on what the next inflation print is. But what this one shows here is you're looking at your CPI, which is the red line there, and the blue one is your CPI or your real Fed rate. Now that has to be positive if it's going to have any effect on bringing down
Wow. Okay.
inflation. So what I'm saying is it's still easy monetary policy now. They're not tightening. Yes, they're tightening a tiny bit because they are increasing it, but not by a hell of a lot, because inflation has gone so high. The ability to bring inflation down requires them to bring it a lot closer. I mean, you see 1980, in the early 80s when they brought it there. To bring inflation down, they really had to increase interest rates significantly to actually start bringing inflation down.
That's at 10%.
Yeah. So, that's the real interest rate. So at that point, it was around 20.
Jeez. Okay.
But there's no way the Fed can do that now, because we're in a different world now. There's way more debt.
I always think of
no mortgage rates.
Of that poor 48-year-old American who's been working for 20 years and still paying off his varsity debt and this and that. He's never had to deal with inflation effectively. I mean, we think about it. He's in the last 15 years, they've never had inflation in the States.
Well, they haven't had it since the 80s, the last 40 years.
And now these poor people have to work out how to deal with increasing prices.
Well, we're a bit more used to it because we've had inflation.
Yeah.
We only had relatively low inflation for the more recent time. So it's not so unusual to us, but you're right. It's going to be a tough one in the US.
Yeah.
And the thing is, already you're having huge things. You're going to see crashes, problems in housing markets because people can't afford to house as their bond prices go up.
Yeah.
The bond prices for houses,
Yeah.
what they call mortgages in the US, start getting higher.
Okay, so let's again we sort of pushing along here, and I'm looking at the time. And let's move on to we've been talking about inflation. Let's go right into this.
Okay.
Let's talk inflation.
All right. Well, this is just showing that because inflation is so high, you can see that the market is expecting a recession now. I mean, this is the Fed, the Consumer Sentiment Index. It's the lowest it's ever been since they measured it. So it's a huge low. Now, recession, the market's not fully pricing recession in yet. Everybody's still saying it's there. Recession is guaranteed for Europe. With the fuel price and the gas price, energy prices up there, I mean, it's not only is that guaranteed for Europe and baked in the cake. I mean, it might actually be depression there, because if they can't get in energy pricing there, all the big manufacturing in Germany has to shut down. Because they never built anything, they're now on coal, they can't get more, there's no natural gas, depending on Russia there. So Europe's already got a recession. And there's always been that saying, which people have said for years, don't fight the Fed. Because the Fed up till now has been, we're going easy, we're going easy. And anybody thought that the Fed wouldn't be able to do it was wrong. But now, if the Fed says they need to create a recession, because they're going to bring demand down, it's the only way, because this is supply. The reason we're getting this inflation is there's just not enough supply, there's not enough oil, there's not enough commodities, there's not enough.
So you've got to take
everything.
supply, you've got to reduce the supply by increasing inflation. What? Creating a recession?
Yeah, to reduce demand.
To reduce demand, and demand is effectively created by the
people having more money to spend.
The high employment rate in the States.
Well, high employment rate, people having money. So you always have to have a reverse wealth effect.
Yeah.
So bring the stock market down. Have people spend less money, because that's about the only way. But the amount that they have to do that is going to be significant, as you saw from the previous one. What it makes it clear is, we've passed what people used to call the Great Moderation, where we've had, nearly 40 years of, in the US, to a large extent, inflation that was, very moderate. We've now broken well out of that zone. And at this point, I don't believe it's transitory anymore. I believe we've got what they call secular inflation. It's now baked in, and it might come down a little bit, but then it's going to go back up again. I think in those areas, it's not going away. And that puts us in what's been a big word that everybody's been around now, which is called stagflation. So you've got low growth or a recession, and you've still got high inflation. Because once the Fed is unable to keep raising rates, because it's literally pushing the growth so long, and it will actually create a depression, we end up having inflation that's stuck. You actually can't get rid of that inflation easily.
And you've got a stagnating economy.
Exactly. So
great fun. Okay.
Yeah.
So German inflation, now you were talking about Europe.
Yeah, I'm just saying Europe. Yeah. So looking at Germany. So the yellow one is German inflation, which is 7.9, but the white one is what they call producer price inflation. So that's the inflation that companies face.
Now that's the lead indicator of Europe.
Yeah. So consumer is what you and I, it's your basket of what you buy, your car, your fridge, your groceries, your Netflix, whatever it is you pay for. But producer is what it's the iron ore they buy, it's the commodities it's the diesel they use in their trucks, it's the the wage cost that they pay their people. In Germany, that's 33%. Now that tends to lead normal inflation by about 5 to 6 months. Not all of it always filters through. It depends on how much companies can pass that through. How much are they prepared to let their profit margins fall? Yeah. So if they're going to not drop their profit margins at all, inflation is going to be 33%. Wow. Yes, they'll take some of it in the profit margins that'll drop down, which means maybe inflation is not that much, it'll be less. But of course, that means the company's now way less profitable because it's not been taking no margins. Once again, it affects its earnings and stock price. So that's when you call almost the earnings recession, where earnings start doing less well on stocks. That's all over Europe. Look at Spain, their PPIs was nearly 50%.
Sure.
So Europe is in huge trouble. The USA is not so bad, you saw there, it's around 10%.
This indicates inflation to come.
Yeah, to companies. So it's indicating inflation to come, either to come or it's going to be shown in lower corporate profits. Okay. So in one of those two places it shows up, because that's now what companies are paying. That's companies' inflation. So it's either going to be normal inflation or it's going to be profits. Neither of which are great for the stock market. Because either you're going to have high inflation or you're going to have lower earnings.
So does that mean we're moving closer to having more money in cash?
Well, it looks like that. It is negative, and I'll go through it in a moment. What I want to just give a last point on a recession here is if you look over the last 20 rate hikes, only 3 of them did not end in a recession. And those were in different market, very far different markets. Here we're in a very highly inflationary market, a highly debted market, where so many things are turning over at the same time. We talked about before, that I think the chances of not ending in a recession here are minuscule. The question is not that we're not going to get a recession, but how bad is this recession going to be? Is this going to be one of the biggest or worst ones we've seen?
No, just looking at this, the worst one we've seen is 1929 that we all know about.
Yeah.
Or sort of the 30s, let's say.
So the question is, are we going to get that far?
Yeah.
And, when we're talking about like stocks and bonds, you can see here, some of it has already fallen down. But as I mentioned before, tightening hasn't really started yet. Mainly it's been people talking about it. They've had, a couple of 25, 50, and 75 basis point hikes. And this is looking at all of the balance, for all of the other G7 countries, including Japan and China and Europe. So when you combine them all, they haven't started easing. They're starting to get more, but they're in a situation where they've also got huge amounts of debt. Europe has to keep Europe from falling apart. If their thing goes up too much, they're really heading for a recession regardless. They cannot raise rates much at all. So you're not getting a lot of world tightening, and it's already turning down. If the Fed was to even go a little bit more, which they need to stop inflation, or inflation is going to go up from 8.6, you'll see it over 10 soon. They have to do it there, which is negative for stocks and bonds. So we're seeing that. Even with the recession coming, it's even hit those type of shares we've been in, which are the resources and the commodities and the energy and the agriculture. So that's gone down. We did really well out of it. It's turned down now. But once again, it all becomes a question of how far does demand break? Does demand break down more than supply? And we see all those big problems with supply coming. But yeah, the stock market, I think we're in a rally period at the moment, especially now because whenever you have situations where you have stocks underperforming bonds, you've got these things in America, which are a massive part of the market called target date funds, they're always a set number of, equity and bonds. So if your equity underperforms your bonds, you have to then sell your bonds and buy more equity. And we've had a huge underperformance of equity. It's been 20%, roughly 20% down since the beginning of the year. So now people are having they have to sell bonds. I was reading that there's about $200 billion that needs to be bought in just from target date funds in the US, listed ones that are buying over the next couple of weeks. So we have a rebound running, which is a nice one for us to take profits on some things, get ready for what I believe will be the next downturn after that.
Okay. So the party's over.
Well, not over. Just to go back to the commodities, these are Russia's commodities.
Okay.
You see, Russia's coming off the world's market. So for this, a lot of stuff that South Africa produces, platinum, palladium, gold. Okay, oil and gas, that's our problem for South Africa. But we're big corn producers, coal, if we can ever get it anywhere. So once again, these things, they're bad for the world because the prices of these things are going to go through the roof. Think about manufacturing cars when you can't get your palladium, what's going to do to aluminium production, all of those type of things. Never mind the energy prices. So everything's going to get a lot more expensive. South Africa as a commodity producer will benefit from that, which will help offset what we need to do in importing our oil price to a large extent, and we are food secure. So from that point of view, South Africa is in a very lucky position compared to the rest of the world. It's still, we could still be sitting at 40 rand a litre, in a year's time, which won't be so nice, with food prices double, which is going to make a lot of difficulty. But at least we're not looking at massive problems in so many other parts of the political problems will be all the people wanting to come from northern, all the migrants that are going to be basically economic refugees coming here in a big way. That's going to be, xenophobia things. You're going to see a lot of that.
Probably means that the European migration problem will actually get worse.
For them too, yeah. For them too. So, because we're on both sides of the part of the world that's going to be worst affected by what's pretty much happening on the global stage. And when looking at the commodity prices now, if you look at the previous, previous commodity runs that have happened, you can see that they always go to new highs almost, and we pretty much only about a third of the start through. Everybody says, it's run up so much. I think we're maybe the first third of this commodity cycle through, which means I still believe miners, commodity guys, which are still, for all the reasons we've discussed before, still relatively cheap, and they are producing cash at a massive rate. Look, even compared to the last commodity cycle which we had from 2000 2010, look how much cash flow commodity producers are producing now because there's less of them. They're producing a lot less. Now demands are a lot higher, and
aging infrastructure, which is being paid for.
Yeah, the aging infrastructure, nobody's been investing anything new in it for a while. So the guys that are still going are making a lot, and people haven't been investing in them because, as I said, most of the big institutional investors, pension funds, aren't allowed to invest in them. They're going to change that because that's our only place to be. I can't imagine those rules will stay too much longer. But anyway, so that's just a bit of a feel of where we're sitting on that.
Wow. Okay. So you talk about commodities. Gold?
Well, gold also, gold has been disappointing in the last year because once again, if you were gold bugs, they always said, for years, I've always heard the gold bugs always saying, no, we need inflation, they're going to be printing money, we're going to be in a world war. anything that they said, no, I mean, I've been telling you this for a while. It's all come true, but gold hasn't moved. And gold also hasn't moved really from the perspective of that it hasn't fallen. Remember, interest rates are rising. Gold normally always crash badly with interest rates, so it's staying there. And gold is really waiting to see, is the Fed serious or not? Will the Fed blink when we are facing a serious recession in the US and the stock market is down another 23% from these levels? Will the Fed say, okay, we are now we're going to stop raising rates, or stop raising rates or not, start cutting? If they do that, and inflation is still high, which I clearly expect it to be, because food and fuel is something the interest rates have nothing to do with. It's supply side, it's physical. You can't change it with interest rates. All you can do is crash demand to depression levels to actually change that price. So we're still going to be sitting with high inflation. If at that point the Fed says, okay, we can't do it anymore because we're going to destroy the economy, then that's almost when that is the moment that gold starts performing. Okay. Now, when that moment happens, is the markets will see this before happening. They'll see, oh no, the markets are getting too weak. It's there, and the Fed's about to turn. So it'll be pre-run. So it's something you almost want to hold in time. Gold's not going to run now. And if we see a significant correction going forwards in the markets, everything gets sold because people sell the stuff that's still making money, and gold hasn't fallen. It's still up like 1%, or it hasn't really collapsed. So it's a place that somebody can sell to create liquidity. So if there is a crash, and I mean there hasn't been a crash now. I mean the markets are down. That's a very orderly decline. It's not a crash. And even if we carry on with an orderly decline, and we end up, whether we see a crash or not, just another orderly decline down, another 23% down. Gold should still, I don't see that as the time for gold to run. But what I cannot predict is the time is at what point does the Fed change its mind? And the minute that happens, gold is, I'd imagine gold would be well over 2,000, if not 2,200 by the end of the year. And then it's open question on how much the Fed then does it have to print to try to keep everything going again.
Okay, so we think, I mean, gold has no value. If you look, I mean, it's sort of what beginning of 2021 at about what 1650 or something, and
we've held
went all the way up to 19. It's come back to like 1830.
So we've held it through that. So it's done well for us, and then when it's reversed, it's done badly. But we're going to hold that position. Once again, that is the long term. What I've been telling you for a while, I said that in 10 years' time, gold will be the best performing of the asset classes. But at the time when it performs, I can't tell you. And it'll happen faster, because there's going to be a change in everybody realizing that the Fed's changing before it actually hits the market. So before it happens, you're going to see that. That'll be the start of gold's run. And we're not too sure when that'll happen, but I think it should be potentially even a little bit this year. Could be next year. It all depends on how far we end up falling and what the Fed does.
Okay. We're into the last 10 minutes, so shall we take some questions? We have a few. The first one is there a chance, Cole, that in this doom and gloom you're wrong?
I hope I'm wrong. Okay. I mean, like when we put the balance fund in place, we put in other funds that think very differently, that are invested in tech stocks and low duration, all of the those type of stocks. Again,
But those aren't in this fund.
No, they're not in this fund.
Yeah.
No, so
in our other two funds.
Yeah, and the other funds that we have. So for a balanced portfolio, you do take your different. We hedge our risk in case.
You want to stop sharing there?
Okay. You stop sharing.
Because now we're kind of gone off. Yeah. Okay. So you were saying those are our other two funds, but in case we're wrong. Okay.
Yeah.
Okay.
So in case you're wrong. So if I'm wrong in this one, well, we're still in. Maybe we might not do as well as I expect to do. And we might not get that, uranium going up 2,000% like we got the last time. But uranium still has to go up, regardless of what happens. That is a fundamental one. And so maybe we don't get, we don't get a recession for some, and the Fed manages to thread the needle perfectly and reduce inflation, and do that somehow. If more food is produced, oil, they don't stop oil, so the oil just goes to China at a discount. Russia keeps producing its oil, and people start building out, the other energy sources. There always could be something that can happen. Let's hope that there is something that happens there, because the outlook, and especially the one for food, is the one I'm most concerned about, because that's the one that creates
the biggest problem.
And the most misery in the world that hopefully we can avoid.
Okay. Yeah. Next question. if Ukraine joins the EU, what will Russia do, and will the EU fight Russia directly? That's a very political question, I think. But
yeah,
what do we think?
Well, Russia was never really interested in Ukraine specifically. The reason Russia had to go was there's like several areas that Russia has been invaded through. There's 9 gaps, and 3 of them are on the European side. There's the Bessarabian gap, the Polish gap, and through the Baltics. And Russia always believes that there's its vulnerabilities. So its primary move was to go, almost go back and stop those points. There's been a lot of talk about, Putin, being this, evil, evil guy wanting to create Peter the Great thing. But a lot of what he said he's been talking about for years and been very clear about it. He says these are our existential threats. And the reason why it had to happen now, it was always going to happen, but it had to happen now, is 2 things. Firstly, Russia is also a massive demographic decline. They're an aging population that's fast. If they didn't do it now, in 10, 20 years, they wouldn't have the soldiers there to do it, to even put in those places. They're literally at that situation. They're at the point where, already because of the European climate goals, Germany was saying they want to get off natural gas, in a few years' time. So this is the last time Russia would have that leverage where they can actually play the energy card against Europe. So Russia is going into Ukraine, and what's happening now is they're just going, they tried to do it fast at the beginning and they were useless at it. They just got badly beaten by the Ukrainians because they weren't ready. And now they've gone back to the old way of starting, where they just go under massive artillery fire, inch by inch, blow up anything that's standing, especially infrastructure. And they're going after things like agriculture that they're targeting, all the stuff that makes Ukraine livable. So the whole point of it is they're just going to go there and just send everybody as refugees out of Ukraine, just flatten the place. And now they're doing it quite successfully because they can have their old World War II artillery and their ancient tanks. It works fine. Already, if you look at it in terms of the aid that can come from the rest of the world, I think America's given about a third of their javelins and half their Stinger missiles. They haven't put any new orders for them. So all of those things that gave a huge advantage to Ukraine at the end, that aid's almost come to an end. Literally, America has to start rebuilding new ones, which, by the way, is, the defense industry is another thing we can talk about. I think there's some opportunities there.
That's a webinar all of the time. Yeah.
That's another one there.
Okay, let's the new combination of China and Russia and talk of a new currency. Will this work? I think that's the BRICS currency. That's a question from Roger W.
Okay.
And it's not really a currency though. It's
well, it is. It's sort of becoming a commodity-based currency. Now that's something Keynes talked about before they went to Bretton Woods, where they made the dollar reserve currency. They said, let's make a currency where it's a basket of commodities. They were mainly looking at gold at the time. And everybody, only central banks, so not you and I, but the central bank can always go and swap their currency for that, and everybody floats against the specific basket of commodities. And that is something that the BRICS are putting in place, and I imagine they will put it in place. That all happened when when the US took that $600 billion away from Russia and said, basically, if you've got dollars and we don't like you, your money just disappears. And think about what happens to China, that are one of the biggest holders of treasury bonds. Saudi Arabia, who was on the bad list a while back, after they chopped somebody up. So a lot of those countries can be on America's negative list, and they realize that you do not want to be holding dollars as a reserve currency. And what's interesting about it is if you look at the politics within the US, the people that want the US as a reserve currency, all the people we always hear from, the financial guys, the guys that run Goldman Sachs, JP Morgan, the Fed, because you can then print money and buy stuff, but the net effect of being the world reserve currency is that your country has to run a double deficit. You have to then put your jobs in another country because you have to keep paying out. You have to pay out. So you have to have your jobs in other countries, which has hollowed out a lot of the industrial part of the US. Wow. And actually, the Defense Department for a long time in the US has been pushing to get rid of the reserve currency, because it's hurting middle class Americans, it's hurting our ability to produce stuff. And what's interesting is, I've been reading rumors that the first time the Fed heard about the sanctions, when they took the $600 billion, was when they heard about it on the news. So that all happened, with different advisors. So those people that believe there's one block of people who think a certain way in the US, there's lots of different people with different views. Some of them want the reserve currency, some don't. And right now, there's no alternative to the US dollar. So we're not going anywhere except for the US dollar for at least the next 5 years minimum. But the BRICS can build this up. They will start using it, and I think it'll become an alternate currency to an extent, which is not necessarily something the US considers negative. The US is moving away from that side of the world. They're reshoring. In fact, the US is having the biggest industrial build out since World War II at the moment as they're busy reshoring stuff. I mean, China's basically closed down. They just told us, 2 days ago that, they're basically going to be locked down for the next 5 years. So, pretty much anybody that's getting anything manufactured in China now has to scramble and figure out how it's going to be built again, either at home or somewhere else.
End of globalization.
Basically.
What is your view on crypto?
For me, crypto has always been a risk asset, not a hedge. So the whole idea of Bitcoin being digital gold was not the case. It was very clearly just being pushed by, easy money. That's been reversed. For me, the biggest thing about it is there's so many scams in that place at the moment. For me, the biggest one, of course, being Tether. We're seeing some of them unwind now. If Tether collapses, that's got a lot of flow from the crypto point. So I believe crypto can have a significant crash. I would not touch anything there, at least until the Tether clears itself out, because that's a clear Ponzi scheme. Obviously, otherwise they'd have told long ago that they actually hold some real assets behind it. So as a result of that, crypto won't clear out. And in many ways, it is a lot like it's a new technology, but as with new technology, people throw lots of capital into the place. Most of it disappears, and then a few winners come out. Now, finding who the winners will be at that point, that's not going to clear out. You've got to clear it all out, and that's not going to clear out until the big scams go. So crypto is still to be avoided. I do believe that a lot of that technology is going to be the way everything works in the future. And some of the people that are winners now, but remember, Amazon fell 90% during the 2000 .com crash. Yeah. So even the winner of whoever it's going to be can still fall another 90% from these levels.
Okay, with all the opportunities being there on uranium and the fertilizer sector, which funds in your stable? Okay, we spoke about that. So the fund is the Global and Local SNN Worldwide Flexible Fund. That's the one with the uranium and the fertilizer stocks in there. that we're investing in those industries, and we've done quite well out of them. Should we be buying Sasol due to their fertilizer?
Sasol's had a problem with its debt for a long time, but yeah, Sasol hasn't been a bad buy. It's done quite well recently, and it's not a company. We're not holding it because we're taking more specific bets directly in fertilizer ones, but I would be very happy with Sasol.
Okay. Last question. Your call on the rand by the end of the year versus the dollar. Jessica R.
Okay. Well, look, the dollar, I believe the dollar is a generally stronger currency for a while just because of the crisis. Yes, South Africa, it comes down to a lot more now. It used to be a case where balance of payments didn't matter. All that mattered was flow. It was interest rates. Who had higher and lower interest rates. Now it's becoming a lot more. There was something like almost 100 times the size in terms of people trading foreign exchange compared to what was actually imported and exported. That's becoming a lot more significant now because you really having to look at how much is South Africa making from its agriculture? What does it have to pay for its oil that's coming in?
So we're expecting a weaker rand.
Generally, I always expect a weaker rand. We've got, and let's see, I do believe because of higher food and fuel prices, we're going to be seeing a lot more riots like we saw last year in September. Possibly quite a few more of those. Well, yeah. Well, those ones last year. So as a result of that, that could be very negative for the rand. Could also depend what ends up happening now with the simplest thing is our current politics. With this whole few $4 million things with Cyril Ramaphosa, is he forced to step down? Does Zuma's guys come back in 12? Anything like that, and the rand is 18-20 very quickly if those type of things happen. So we've got a lot of specific political risk. It's generally would be weaker, but interestingly now against the dollar for the first time on purchasing power parity, the US has high inflation in South Africa. Our inflation is 6.5%. The inflation is 8.6. And with their easy money there, the odds are that can go higher. So shorter term, I still believe the trend is for a stronger dollar for now. I think that's going to change more and more towards a weaker dollar. South Africa has a lot of political event risk. And because of the expected unrest that we'll have later because of the high food prices, that could also weaken the rand. So it's a balance between the two.
Okay, cool. I think that's enough now. We've run out of time. We will be looking at any further questions or comments that have come through, and we'll be responding to you via email. Thanks a lot for everybody. Thanks for joining us. Global and Local Asset Management. The fund is the Global and Local SNN Worldwide Flexible Fund. And if you'd like to talk to us more about it, visit our website or email us at info@glam, GLAM, asset.co.za. Thank you, everybody. Goodbye. Cheers.
Thanks a lot. Bye.